Inflation has slowed down worldwide, from US to Australia to Singapore, which has hit its lowest core inflation in more than 2 years. And guess what? Interest rates are projected to drop globally as well. In today's video, I'm going to share with you how all this important economic data is going to impact you, and importantly, how you can capitalize to set yourself up in a superior financial position. Hi, I'm John, one half of the Corporate Breakout Couple. Just a little backstory about this channel. My wife Fran and I are a financially independent couple who have successfully invested our way to achieve our time freedom. On this channel, we cover a lot of topics around financial independence, about financial literacy, and breaking out the rat race. Before we continue, I appreciate it if you hit the like button and support this channel, and let's go! And just a little disclaimer, this is not financial advice and purely for educational purposes only. Since the global pandemic in 2020, the inflation data in the US have skyrocketed all the way to 9.1% in June 2022 before starting to reduce after the Federal Reserve have started increasing their interest rates to a low of below 3% at 2.9% for the recent July 2024 number. The current US Fed Fund rate stands at between 5.25 to 5.5 based on the latest projection by Jerome Powell, the Federal Reserve Chairman. It is projected to have a rate cut as early as mid-September this year. One of the key reasons why the Feds are willing or finally willing to start reducing the interest rates, which were stubbornly high, is because of the inflation data that seems to point towards the 2% desired rate for a healthy economic growth. So what does this mean? This means that the US economy can be stimulated again by having cheaper borrowing costs for the companies such that they can be more productive and therefore also reduce unemployment rate, which is high now at 4.3%. So the question here is, with cooling inflation data and projected interest rate cuts, not just in the US but globally as well, because the rest of the world tend to follow US, the question is, how can you capitalize on that? I'm going to share with you 3 ways on how you can position yourself financially. If you are somebody who's interested in real estate like me, you will know that property prices and mortgage rates are intrinsically tied. When interest rates go up, it means that mortgage rates go up as well. So for the property buyer, it becomes more expensive to borrow money to hold a mortgage loan, which gets more expensive, which ultimately decreases the demand of buyers in the market, which also pushes the property prices down. It is not just the buyers and the sellers of properties who get affected by the increased interest rates and the increased mortgage loan rates. It is also the developers who are borrowing large sums of money in order to develop land with a forward projection of 3, 4, 5, 6 years in order for them to reap and take back the profits. Therefore, as interest rates are high, developers are less likely to want to develop land rapidly, and therefore supply decreases, which is also the inventory. Now, the dynamics of the different real estate market varies depending on supply and demand for that country. But what's important to note is that the interest rates, which directly affects the mortgage rates, impacts the pricing of the buyers and sellers and developers in that country. Let me share with you a personal example. For me, a Singaporean, as I'm heavily vested in the Singapore real estate market, here's what I did in 2020 when my wife, Fran and I noticed that, hey, you know, the pandemic has happened and people are sort of sitting around and waiting to see what's going to happen next. We noticed that the interest rates were really low, at 0 actually, based on the Fed Fund rates, and we knew that the rates were not going to hold that much longer because eventually the economy's got to open, right? So what we did was we capitalized by selling one of our properties and got really low interest rate, and we locked in for 4 years and the interest rate was at 1.4%. Actually, during the pandemic period, many of my fellow Singaporeans got caught in the sudden increase in mortgage rates because of what the Federal Reserve have done globally, and such that many of them are actually paying extra 20 to 30, even 40% extra per month on their mortgage mortgage loans. So for example, if a Singaporean is holding a 800,000 Sing dollar loan which holds at a 1.5% mortgage rate for 30 years tenure, you're currently paying around 2,007 per month. But if the mortgage rates increase to let's say 3%, which happened in 2022, you're paying at a 3,300 per month, which is a almost 25% increase. The key thing here is no matter which country you are in or which real estate market that you are in, it's important to understand global inflation data and how the interest rates are moving according to that, and therefore you can plan your property plan whether you want to sell or buy at the opportune time. So with the Federal Reserve projecting to do a number of rate cuts in the next 1 to 1.5 years, the mortgage rates is projected to drop as well. That means you should be planning your refinancing, your repricing, or buying and selling of your properties with that in mind. We talked about the real estate asset class earlier. What about the paper assets, the financial markets?
Here's the yearly chart of the S&P 500 index. You can see from October last year, 2023, it embarked on a bull run all the way to an all-time high of around 5,600 points before pulling back to the 200 EMA, the 200 moving average, and then it bounced off and it went back to its all-time high before a few falling knives closer to the 100 moving average at the moment. What about Nasdaq 100, the tech sector? Similarly, in the last 1 year, it embarked a bull run all the way to its all-time high before retracing back to around the 200 moving average, went back up again, but not as high as the S&P 500 before having a few falling knives, which is led by Nvidia. For those of you who follow the stock market, and you know it's closer towards the 200 EMA instead of the 100.
Now, when the financial markets are at an all-time high, seasoned investors and traders will begin to worry because they know that when it's so high at the top, it can fall down very quickly as well. Have you heard of the saying, the bulls climb the stairs and the bears jump out the window? And that means it takes very long for the market to start moving up to its all-time high, but when it drops like falling knives. In these kind of scenarios where the markets are at an all-time high and a potential correction or crash could swipe a big percentage of your portfolio, what do seasoned investors and traders do? They take some profits and they increase their cash positions. Well, if you watch one of the greatest investors of all time, Warren Buffett, and what he did, you'll actually find many clues. For those of you familiar with Warren Buffett's portfolio, you know that his company Berkshire Hathaway started accumulating Apple shares since 2016, such that by Q4 2023, which is end of last year, the portfolio size is almost 50% of his entire portfolio. And recently, Warren Buffett started trimming its Apple shares as much as 50%, such that its current portfolio based on filings for Q2 2024, it ends off at around 31% of their overall portfolio. Have you heard of his saying, to be fearful when others are greedy and to be greedy only when others are fearful? By his actions, Warren Buffett is exemplifying his quote, isn't it? To be fearful when others are greedy by taking profits and exiting Apple by shaving it into half and increasing his cash position to be more than 200 over billion. At the end of the day, nobody can predict where the financial markets are heading towards. But in Warren Buffett's case, by increasing his cash position, he has put himself in a superior financial position to capitalize when the opportunity strikes. When the financial markets are at an all-time high, it is important to look at economic data as well, and especially the job market. Look at what all the big MNCs are doing, not just the tech companies. They are still doing layoffs and they are doing restructuring, such that, in my opinion, they are setting themselves up for the next phase of uncertainty or perhaps a huge bull run. But in any case, they do restructuring so that they can stay lean, they can increase their profit margin so that they can also capitalize during this period. In today's uncertain times where economic and geopolitical factors are heavy in play, it means that nobody can really predict what's going to happen next. So it's important to stay updated and stay connected with the world such that we can stay nimble and move fast when necessary. Earlier on, I talked about increasing your cash position such that you can be ready when opportunity strikes. In my other suggestion here, what I would suggest is for you to increase your contingency funds. Note that this is a defensive move to hedge against uncertain times. The usual recommendation of 6 months of contingency funds, in my opinion, is not enough, because if you're looking at the length of unemployment after layoffs and retrenchment, is no longer just 6 months, it might not be enough. It should be a minimum of 12 months, if not more, because you don't know what lies ahead, and having more cash on hand actually gives you a longer runway for you to have more time to plan and think about your next move. I hope this video has given you many ideas on what to do next, especially during this period of uncertainty, and do note that this is not financial advice, it's for educational purposes only. If you are interested in such financial topics, come join our free masterclasses that my wife Fran and I conduct a few times a month, where we cover topics such as investing, about finance, financial literacy, breaking out the rat race, and many more. Click on the link below to join our mailing list so that we can send you the upcoming Zoom webinar invites. Thank you very much for watching this video. I hope with today's sharing you can understand the game of money better so that you can set yourself up in a favorable position to win. Do hit the like button and subscribe to join our YouTube channel so that we can create more content like this for you. See you in the next video.